Hello, and welcome everyone. My name is Amy Brownell, and I go live on YouTube here every Tuesday at 1 o'clock p.m. Eastern Time, 10 a.m. Pacific, to talk all things CFO and advisory related. So, any questions that you have, I want you to ask them. Today, we are going to talk about a summary P&L and what that looks like and what all of the numbers on there mean. So, like I said, we go live here every Tuesday, and I would really like it if you would please subscribe to the channel. That way you're notified when I go live, when I drop new content, all of that fun stuff. And yeah, you can also join me on Facebook, on LinkedIn. Those links are in the description of this video. And if you have any questions along the way, questions, comments, things to chat about, go ahead and drop a comment and I will get back to you with the answer to that. Alrighty, so let's dive into the material. The summary P&L. So first of all, what exactly is a P&L? Well, a P&L stands for profit and loss. So it's a profit and loss statement. It, at the end of the day, tells you how much money a business made after they sold all of the things and paid all of the bills. How much money did they make at the end of the month? So you may have heard another term called income statement. Income statement and P&L, interchangeable. Those mean the same thing. So you can, anytime you hear P&L, you can use income statement and vice versa. I will say it's probably most well-known as a P&L. So profit and loss. All right, I want to dive right into this. So let me share my screen. Okay, so what we're doing here is we're going to go through an actual business example because I find it easier to learn when you're actually doing, when you're actually seeing it on paper. So we have a business example. This company is called To a T. They make, as you would imagine, t-shirts. And these t-shirts are perfect. Everyone loves these t-shirts. They feel and look designer, but you can wear them every day. This business has one retail store, and that retail store is in New York City, here where I live. And they only sell two products, a men's t-shirt and a women's t-shirt, both in black. So I know that this example is a little like, pretty realistic, Amy. But I wanted to keep the numbers nice and easy so we could really track to see what's going on. The purpose of this is to more understand what each of these lines in the P&L mean and how we can affect them. So let's move on. So here is an example of the first line of a summary P&L. So a summary P&L and a detailed P&L. Let's talk about that quickly. So a summary P&L just has a couple of lines, the main lines of the P&L. So revenue, expenses, profit margin, and profit after expenses. So those four lines. A detailed P&L lists out everything. So all sources of income, including the things that you sell. So maybe there's tax refunds in there, or maybe you sell a service along with your items. On the expense side, it breaks out all of the expenses separately. So on a summary P&L, they're all balled into one line called expenses. Whereas on a detailed P&L, you see things like salaries, rent, utilities, shipping, all of that fun stuff. So it is detailed is obviously more detailed, and summary is a higher level. So what we see here on our P&L is the first line of any income statement, of any P&L, and that is revenue. So think about revenue as what happens during checkout at the cash register. So remember, this is a retail store, so I'm going to talk in terms of we're selling t-shirts. So someone is at your register and they are purchasing 2 t-shirts. Each of those t-shirts has a tag written on it with the price, and that tag says $100. So you take that 2 t-shirts times $100, you get $200 in revenue. If somebody buys 4 t-shirts, that would be $400 in revenue. And then what happens at the end of the month, we add up all of those transactions. So each of those $200 transactions, the $400 ones, all of them, we add them together, and that's what we get for the month of March. So we get $209,000 worth of t-shirts sold in the month of March of 2025 versus March of 2024, we only sold $191,000 of t-shirts. So you can see here, what we're going to do is compare 2 time periods. Typically you want to do, there's a couple of things that you can do actually. You can compare your current month results to the same period last year. And that's helpful because there are some businesses that are very seasonal. And so, for example, a lawn business, they don't have the same revenue in June as they do in December. So you don't want to compare 2 periods that are nothing alike. You want to compare 2 similar periods. So for purposes of this, we are using last year, same month. That's why we're doing 2024, 2025, both March. You can also compare it to a forecast or to a budget. So what did we plan to sell this year? And how did we perform against that number? So in this situation, we are comparing versus last year. This year, we sold about $18,000 more t-shirts, or 9% more than the previous year. So that is the revenue line of the P&L. So let's move on to cost of goods sold. This is an expense line, and cost of goods sold is the amount that it costs us to make each t-shirt that we sold. So for example, we sold that t-shirt for $100, and let's say it costs us $50 to make that shirt. So that same 2 t-shirts that person bought at our register, we're going to record revenue of that 2 times $100, $200. And we are going to record 2 times $50 here on the cost of goods sold line. It costs us $50 to make the shirt. So this cost of goods line should include everything that goes into making the shirt. The salaries for the people who actually sew the shirts, the material cost, the cost of getting it to our store. Say we have them made overseas somewhere, we have to pay to get them here, we have to pay tariffs, all of that goes into that cost of goods sold line. So if you have a business, for example, like To a T, that you have people making the shirts and you have people selling the shirts, we're not talking about the people who are selling the shirts. We're talking about just the people who made the product to sell. That's all that can go into cost of goods sold. So in this case, we had 2 shirts sold, cost us $50 to make each shirt. $100 goes into that cost of goods sold line. We add up all of those transactions at the end of the period, at the end of the month, and we sold about $48,000 worth of t-shirts. I'm sorry. It costs us about $48,000 to sell the $209,000 t-shirts in the revenue line. So that same comparison for 2024, it's costs us $39,000 to make the shirts that we sold for $191,000. So if you look at the comparison, you can see that it costs us $9,000 more this year versus last year to make those shirts, which makes sense, right? Because we sold more shirts. Our revenue was higher. We sold more. So it makes sense that it costs us more to make the shirts than it did last year. But here's the interesting part. Take a look at the percentage, that 23.26. What this is saying is that it costs us 23% more to make the shirts this year versus last year. But here's where it gets interesting. That 9%, you would expect the cost of goods sold to be up 9% because we sold more. So if we saw that 9.3% duplicated down on the cost of goods sold line, that would make sense. But we're not. We're seeing 23%. So that means that the difference between those numbers, what is that, 12%? That's not right. That is not right. 14% that's not right either. You know what I mean. The difference between the 23 and the 9, 22, of course, is what that difference is caused by something else. It's not caused by the fact that we sold more shirts. So then you got to start asking yourself, okay, well, what could have caused that difference? So in this case, it could have been material costs have skyrocketed. So maybe something like cotton prices went up, or the cost to pay the salaries of actually making the shirts. The people who are sewing the shirts, it costs us more to get them. Maybe we had to pay some overtime. Could be any one of those things. Maybe we didn't have a tariff last year and we did this year. Or maybe the shipping cost of getting it from point A to our store in New York City, maybe that price went up. So that's the kind of thing that you're thinking of when you're trying to understand, okay, what causes these differences? Okay, next we have gross profit. Easy peasy. It is just the difference between the revenue and the cost of goods sold. So in this case, it's $161,000 of profit versus $152,000 last year. So at the end of the day, we sold $209,000 of shirts. It cost us $48,000 to make those shirts. And so we made $161,000 in our pocket on those shirts. Does that make sense? Hopefully so. All right, so you can see here it cost us the amount of money, the gross profit that we have left over at the end of the month is more this year versus last year, $8,800 compared to and 5.7%. So you can see there is a bit of a difference there, and most of that difference is made up by the fact that our cost of goods sold line was so much higher. So, yep, of course it cost us more, but it didn't cost us the 9% because that 9% and the 23% are blended together. All right, so we made some money on the shirts. Great. We have to look at also profit margin percentage. So profit margin percentage is just your gross profit divided by your revenue number. So if I said that in a simpler way, maybe, it would be the percentage of money that to a T gets to keep compared to what they sold. An even easier way to think about it would be to a T gets to keep 77 cents of every dollar that it sells. So you can see this year we're keeping 77%. Last year we were able to keep almost 80%. So that number unfortunately went down. And again, that's caused by cost of goods sold. Now, remember what I was talking about before, that you not only need to have the people who are buying the shirts, but you have to have a sales staff. You have to have your store and pay the rent. Well, that all falls under expenses. So you can see here expenses are all balled together in one line item. And the expenses are a little bit easier to think about. Like I said, it's those things like rent, utilities, the bags that we have to give out to our customers to hold the stuff that they sell. like salaries, that kind of stuff. So this year, in March of 2025, we paid $91,000 of expenses versus last year's $77,000. So this year we paid $13,000 more in expenses versus last year, or 17% more. So it's interesting. We would want to understand all of the things that caused that difference. What made up that $13,000? Did our rent go up? Did we pay out some bonuses to our staff? Did the cost of bags go up? Whatever that looks like. Maybe utilities went up. Those are the things that we want to be thinking about when we think about expenses. Okay, after expenses, we got profit. Profit. So profit is simply the gross profit minus expenses. So for 2025, it's at 161 minus the 90,000. That leaves us with $70,000 of profit. So that's how much money we get to keep after we make the product and sell the product. So better said, 70,000 of that 209,000, we get to keep that after we get all of our bills paid. The same number last year was 75,000, so we're keeping less. That's never a good thing. We want to keep more. In this case, it was almost $5,000 less, or 6% less. And then finally, we have our profit margin. And our profit margin is simply our profit divided by our revenue. So, as I said before, probably the easiest way to think about it is that for every dollar of revenue, 2 a T gets to keep about 34 cents. Last year, they got to keep 39 cents. So definitely they were keeping more of the money. We would want to reverse that trend and see what we can do to affect the lines that are impacting that $5,000. We would want to look at revenue. Maybe we can sell more. We'd want to look at that cost of goods sold. Can we bring that number down? We would want to take a look at our expenses. What can we do there? So that is a quick and dirty example of the P&L. Let me click some buttons here, come back. Okay, so that is the summary P&L. A quick walkthrough of the summary P&L. It is a really quick, high-level way to get an idea of what is happening in a business in a given month. So we can see exactly how much we sold, how much it cost us to make what we sold, how much we paid in expenses, and how much we get to keep at the end of the day. Everyone likes that number. So we obviously want that bottom line profit number to be as high as possible, as much as we can control. All right. Well, I think that's about it. If you have any questions, be sure to drop them in the comments. I really had a fun time explaining this to you. I'm such a nerd. I love finance stuff. Hopefully this was helpful. But yeah, if you have questions, be sure to drop questions, comments in the area below. And then be sure to follow me on Facebook and here on YouTube. Be sure to subscribe to the channel and on LinkedIn as well. All right. So I will see you back here on YouTube next Tuesday at 1 o'clock Eastern, 10 a.m. Pacific for another episode of the CFO Insider, where we talk about all things CFO and advisory related. All righty.